Over the last few years, my stock portfolio has averaged over a 20% rate of return annually. Now, for reference, the stock market historically only returns about 10%. So how am I able to more than double the anticipated results of the stock market? No, I didn't get lucky. I'm not a stock picking savant. I didn't take any additional risk. What I did was I used a tried and true method that is scientifically and mathematically proven to beat the long-term results of the stock market had you instead just went out and bought your favorite stock, collected dividends over the years, and just waited for that stock to appreciate in value. This method will beat that buy and hold strategy. Hi everyone, my name is Ben, and this channel is dedicated to all things personal finance, helping you earn more, spend less, and invest the difference. Now, usually if things sound too good to be true, they are. However, in this case, this method actually works. If I had to rate this, I would give it like a 10 out of 10. It's safe, it's secure, it's scientifically proven to work in the long run. And the best part about it is, it's easy. You can learn everything that you realistically need to know just by watching this video. And then all you have to do to execute this strategy is log into your stock portfolio once a month. It takes about 3 minutes and it will increase your returns. All right, guys, before we get into the specifics of how this method works, I need to show you just how powerful this is, because I don't think that some of you guys fully understand just how ungodly powerful a 20% rate of return is. This will get you out of the rat race, the 9-to-5 grind, and it will get you on your way to financial freedom. That's how powerful this method is. So what I've got here is I've got a standard investment calculator pulled up, and I've got this set for 40 years. So maybe when you start investing after college or something like that, going through age 65, the classical age of retirement, 10% annual rate of return, that's the US stock market average, and all we're doing is contributing $100 a month. We're not putting thousands of dollars in or anything like that. $100 a month is very doable. So if we were to do $100 a month for 40 years at a 10% rate of return, we would end up with roughly $560,000 in our account. But what if we could get better than a 10% rate of return? What if we could get a 20% rate of return like I claim? Now, some of you guys out there might be thinking, well, the rate of return is double, so your ending balance should be double. But that's not the way that exponential growth and compound interest works. If we hit calculate, you'll see that now the ending balance has jumped up dramatically to almost $10 million. That's what the power of this method. It will get you out of the rat race. This is almost like a financial cheat code. So let's actually see how this works. I've pulled up the Apple stock over here in Robinhood. Now, you can do this in any brokerage account you want, TD Ameritrade, Charles Schwab, Vanguard, it doesn't matter. I just like the layout of Robinhood, at least for making these videos. Now, first and foremost, we are gonna pick a stock that you believe in for the long haul, that you wouldn't mind owning. You think that this is a good company. That is first and foremost what you need to do when you're picking these stocks. Now, you can pick individual stocks or you can pick index funds, maybe like VTI or VOO, some of Vanguard's index funds. But one thing that I will say is that you have to own at least 100 shares of whatever company it is that you're going to be doing this with. Now, for Apple, that might be a little bit expensive because 100 shares of Apple, that would be over $14,000. So that might not be something that everybody could do. Maybe you would have to pick a different company. But bottom line, don't pick a company just because it's cheap and you can afford 100 shares. Make sure that you actually like the company and think it has long-term potential. Now, what we're going to be doing in this video is we're going to be selling covered calls. Now, there is a lot of math that can get involved if you really dig into it, but we are going to simplify things. I'm a big fan of the KISS method. Keep it simple, stupid. We're going to show you just what you need to know in order to make this work. You don't necessarily have to understand all of the different mathematical principles. You just have to know what numbers to look for and what buttons to click. So basically, we're going to come over here. and we're going to hit Trade Apple Options. If you don't see this button, it's because your account has not been activated for options trading. Options trading is a slightly more advanced method of investing than just picking stocks and buying them and selling them. So if you don't see this, there's actually a short little survey that you have to fill out. It's a handful of questions, just making sure that you're not a complete rookie when it comes to investing, that you know what you're doing. You fill out that survey, send it off. It takes about 2-3 days usually to get approved, and then your account will be enabled for options trading, and you will see this button. So we're just going to go ahead and click this button here. And oh my goodness, we see all kinds of different numbers here in this little table. What are we looking at? Well, first and foremost, there's a couple of different things that we can do. We can buy and sell these options, and we can buy and sell either calls or puts. Now, in this video, we are only going to be selling covered calls. To me, this is by far and away the safest of the 4 methods out there, and it is statistically guaranteed to work in the long run. That's why I do this every chance I get. All right, so what are we actually looking at here? So this green line right here, that is the current share price of Apple. As I'm making this video, the stock market is not currently open, so this is not fluctuating at all. All right, now what we're gonna do is, first thing, we are going to set an expiration date roughly 30 days in the future. You can choose any one that you want. I like 30 days for a variety of reasons. Primarily, it means I don't have to go in and log into my account every week or every couple of days or anything like that. I can do this once a month, set it and forget it. So I'm making this video on the evening of July 22nd, so I want to pick one that is roughly 30 days in advance. Now, as you can see, it's going to sort them over here by the strike price. So what is all of this stuff exactly? When you are selling covered calls, you are selling an options contract. So basically, some other investor in the world is going to go out and buy this options contract from you. And they are going to give you a fee when they buy this contract from you. Now, what that contract does is it basically says that they have the option to buy your 100 shares of Apple from you on the expiration date for the strike price. Now, that doesn't mean that they have to buy it. Remember, they have the option to buy it. Now, when we're picking which one of these different options we're going to go with, we are only going to be looking at the numbers above this green line. So all of these numbers down here, we are going to completely ignore this stuff, and we're only going to be looking at the ones up here. Now, which one in particular should we pick? Well, like I said, the math on this can get obnoxiously complicated. So the simple down and dirty version that I use all the time is we are going to look for a delta of roughly 30. So when you click on these, it's going to bring you up a bunch of additional numbers, including the Greeks. And this is where the math gets really crazy. You have delta, gamma, theta, etc. And all of these mean different things. So for example, theta is the time decay of this options contract, and delta is basically how much this fee changes for every $1 change in the underlying asset. And you really don't need to know any of that stuff necessarily. It's great if you do know it, but you don't have to. All we're going to be doing is looking for a delta of roughly 30. So here you see a delta of 43, so that's a little too high, so we're going to check this one, delta of 40. We're going to keep going up, 32, and 25. So it looks like this one of 32 is going to be the closest one to 30. So if I were to be selling this covered call, this is the one that I would select. So what happens if we actually try to sell this covered call? Well, like I said, when an investor actually buys this call from us, they pay us a fee, $2.32 for this particular one per share. Now remember, when we're doing options contracts, everything is a multiple of 100. So selling one contract means you are selling the option for 100 shares. So this $2.32 per share, when they buy this contract from you, that means that you are getting paid $232 when an investor buys this option contract. And like I said, they are buying the right to buy your 100 shares of Apple from you on the expiration date for the strike price. Now, as you'll notice, the strike price, since we're looking only at the ones above this green line, is more than what it is currently worth today. So basically, that investor that is buying this options contract from you thinks that Apple is going to go up in value significantly in the future. That's why they are buying this contract from you. Now, realistically, there's three different things that can happen between now and the expiration date. The stock price of Apple can go down, it can stay relatively flat, or it could increase dramatically. So let's take a look at all three scenarios and show how you are going to come out well in advance financially, regardless of what the stock price is doing. All right, so let's say, for example, that the stock price goes down. On August 20th, the stock price is $142.25. It goes down by $5 per share. Well, in that case, the price of $142 is lower than the strike price. So that investor is not going to exercise this contract. He is not going to buy your 100 shares of Apple from you. So you hold on to your 100 shares of Apple. But you still collect this fee that he paid you, this $232 fee. So while you're not thrilled that the stock price went down, you lost $5 per share times 100 shares, you lost $500 worth of value. That's not the end of the world, because like I said, you believe in this company. You think it's worth holding on to for the long haul. So just because it had a bad month isn't the end of the world, because you were going to hold on to it anyway. So you lost $500 in value, but you gained $232 in fees. So it basically cut your losses in half by doing this. So when the stock price goes down, you're basically being able to collect some fees to mitigate any losses. So if the stock price goes down, you are winning relative to had you not sold this options contract and you just held on to your 100 shares. Now let's say that the stock price goes up a little bit, and let's just say that on August 20th, the final price is $150. Well, in that case, it's still lower than the strike price, so you are not going to have your shares called away from you. You are going to hold on to your 100 shares of Apple. You still collect this fee, you get $232, and you're happy because the price of your stock went up by a couple bucks. So not only did you get the fee, but you got the appreciation of your stocks. That's a double win. Now let's take a third option and say that, you know what, on August 20th, the stock price went up dramatically. Maybe it went up to $160. Well, in that case, since the final price on the expiration date is more than the strike price, this contract will be executed. It will be assigned. And that means that your 100 shares of Apple will be sold. You will have to sell your 100 shares of Apple. And even though the current value is $160, you're getting paid $152.50 because that is what this contract stipulated. The buyer of this contract had the option to buy it from you for this price. And since it's worth more than this price, he is going to go ahead and execute that option and buy these shares from you. So you get $152.50 per share times the 100 shares. So you would get basically $15,200 in cash from that investor, plus the $232 in fees. So while you no longer have your Apple stock, you do now have a bunch of money in your account that you can go buy something else with. Maybe you just go buy Apple stock again, or maybe you buy a different stock, whatever is up to you. Now, you might be thinking, oh man, that stinks. I lost a little bit of money because I sold something that was worth $160, but I sold it for only $152.50. Yeah, but remember, right now it's only worth $147. Pull up a calculator. We can see that that is a $5.25 difference. Multiply that by the 100 shares. So when we sold it, we made a $525 profit from the price appreciation, in addition to the $232 fee that we collected on this options contract. So even though we sold the final 100 shares of Apple for less than it was technically worth, we still made a profit of $757. So we still won, we just didn't win quite as much as we otherwise could have had we not sold this covered call. As opposed to had you just bought 100 shares of Apple and just held on to it for years. If the price goes down, selling covered calls keeps on netting you this fee. If the price goes up or stays flat a little bit, you collect this fee and potentially some price appreciation. The only time that you technically lose is if a price jumps dramatically in a short amount of time. But realistically, that doesn't happen too often. Most stocks are relatively stable. And that's why we are checking this delta. We want to make sure it's right around the 30 mark, because historically that's been sort of the sweet spot. Because as you can see, some of these pay out more money, right? So you would collect a higher fee if you sold this one than if you had sold this one. However, the strike price is significantly lower. This one, the price only has to change by 75 cents in order for this one to hit the money, to be in the money. And so this one has a much more dramatically higher chance of actually being assigned and you be forced to sell your 100 shares. So a quick recap: when the stock price goes down, stays flat, or even goes up a little bit, you're going to be able to keep your 100 shares, and you are going to be continually collecting this $232 a month, because on August 20th, when this contract expires, we can just pick another contract expiring in September, October, November, etc. We can do this every 30 days and just keep on collecting these fees. The only time that it comes back to bite us a little bit is if the stock price jumps dramatically in a short amount of time. But like I said, that's still not the end of the world, because in this scenario, even if it jumped dramatically, we still made over $750 in profit. So as I said, more often than not, you're not having to sell your shares. You are just simply collecting an additional fee month after month after month. And this fee adds up to a significant amount of money, because like I said, we can do this every month. So let's pull up our calculator again here, and let's just say that we do this every month. So $232 times 12 months in a year. So that would get us close to $2,800 a year just by selling this options contract. Now, 100 shares of Apple cost us $14,725. So if we take our profit and divide that by how much it cost us, our expenses, in order to buy these 100 shares, that's showing an annual rate of return of basically 19%. We're making 19% on our money just by simply selling these options. And that's not even taking into account the fact that more than likely over the course of that year, the stock price of Apple will go up as well. So you're basically going to have a total rate of return of this 19% plus however much Apple increased in value over the course of a year. That's how we're able to dramatically beat the average rate of return of the stock market, is we're just simply collecting these fees month after month after month. Now you say, well, what about those cases where we had to sell our options contract, we got assigned, and the stock price went up dramatically. All right, let's take a look at that example one more time. Let's just say that the stock price went up to $160, and so we were forced to sell at $152.5. All right, so in that case, we still made $152.5 minus this $147.25. So we made $5.25 per share times 100 shares plus our $232 fee. So we made a $757 profit, like I said. And if we take that profit divided by our cost of our shares, this $147.25, that means we got a rate of return. We made a 5% profit in 30 days. Look, guys, I know a lot of people out there would be happy just getting a 5% yearly rate of return, but this was sort of a worst case scenario. Our options got assigned. We were forced to sell our 100 shares of Apple, but we still made a 5% profit in only 30 days. What if we just did that month after month after month? That would be a fantastic rate of return. So being forced to sell and having this contract be assigned, it's not the end of the world because you're still making a lot of money. So to recap, all you have to do is once a month log in and make sure you are selling covered calls 30 days in advance. Pick the one with a delta closest to 30 and just go ahead and sell that options contract. In the long run, this is statistically proven to beat simply buying and holding on to Apple shares because month after month after month, you are constantly collecting this fee from whatever investor buys this option contract from you. If you enjoyed this video, please be sure to subscribe, leave a comment down below. I love hearing from you guys. And as always, I'll see you all again next time. Thanks.